Markets are gearing up for the Federal Reserve's first policy meeting of the year. For insights on what the Fed might do and say about rates this week, we want to bring in Roger Ferguson. He is former Fed vice chairman, also a CNBC contributor. And Roger, normally I would be asking you what the Fed's going to do, what they're watching in the markets. I have to start by saying if you were still vice chairman and you saw the moves you're seeing in the markets this morning, based on the potential shift in AI and the competitive landscape, how would you be factoring that into how you felt about any rate determinations for this week?
Look, I think it's too early to factor it in a narrow sense. I think the real question is, is this AI going to unleash, as we hope it does, another productivity boom, which would make things increase the potential growth rate, and the Fed would have to manage through that. And so I don't think it's a short-term question. I think it really is this a tectonic shift, as with the last productivity boom, that gives the Fed some more flexibility? And one can hope that we can have higher growth with lower inflation. So that's where I think about the AI question.
Okay, that's really interesting. So this is something that's going to play out over time. How long did it take to really figure out that we were in the productivity boom that we were in the last go-around?
Well, it's a very interesting question. Actually, Alan Greenspan figured it out before others. During his tenure, there are a couple of well-respected governors who wanted to tighten policy, thinking that we were on the verge of an inflationary pressure. And he slowed things down quite a bit and proved to be right. And so I think that this one is slightly different in that it's much more visible, and we're starting already to see some of the impact. So I think this will play out much more quickly for reasons that you've talked about. Businesses are adopting this technology, using it to change how they do business in things such as call centers. So I actually expect this to play out relatively quickly, and so much in the news that I think all of us will be able to see it and measure it for ourselves.
You know, a week ago, I would have said that I would have expected the Fed to pause at this go-around. They kind of set it up for such. We've seen the rate cuts. We've seen a lot of questions about what comes next. And I thought the FOMC was kind of in a good position to just pause and look around. Then you've got a new president, a new administration coming in, and that president has been very vocal about how he wants to see rates lower, not only here, but the rest of the world, too. What kind of additional pressure does that add, and what do you think the FOMC is going to do this week?
Look, it obviously adds some pressure to have such a vocal discussion on interest rates from the very top of the power structure in the United States and indeed in the world. However, back to your first point, the fact that it was so widely expected that they would keep rates steady at this meeting, pause and look around, as you say, I think they're certainly going to be inclined to do that. I don't think they want to be seen to be changing strategy or tactics based on outside pressure, and I don't think the numbers would support it. So I think their own credibility and the wiser move is to continue with the status quo, as already suggested, pausing, looking around, waiting to see how things unfold.
That makes sense. I get it. But then you watch what happened with Colombia over the weekend when the pressure really came down and the quick about face that Colombia's had to do. Do you anticipate that there will be some sort of massive amount of pressure coming from the White House, coming from the bully pulpit at that point? And how does the Fed react, again, if that's the case, if they get immediately publicly rebuked for not cutting rates?
Look, I think they're probably expecting that to occur, so it won't be such a surprise. I think it's very important for the Fed to position itself not in opposition to the administration, but rather focusing on the real economy. And so I think they're going to, during the press discussion and other places, emphasize Fed independence, talk about how incredibly important that is for the stability and growth of the United States economy, which we all want. It's very important for the ability of the United States to continue to issue debt, and we haven't yet seen, how the first reconciliation plays out. And so I think they're going to ground themselves in, an independent Fed being data dependent at this stage is better for everyone, and by implication, better for the president himself. That's not going to stop the president, and I don't want them to get into a tit-for-tat war with the president. But I think they're going to have to stand their ground in terms of being an independent agency, taking a long look and keeping inflation under control while also, focusing on maximum employment.
But Roger, your feeling is right now is the economy is arguing for a pause, not a move in any direction.
I think that's right. You know, everyone has recognized, including Chairman Powell, that inflation seems to be moving sort of sideways. We do seem to be having growth that's, you know, at or slightly above potential. An unemployment rate at 4.1%, used to be considered full employment. None of that sets me up, or I think sets them up for a cut in the immediate future. On the other hand, you know, inflationary pressures, while, you know, sideways, have been moving down, and we're waiting to see what the new policy prescriptions are in terms of fiscal policy. So I think wisdom at this stage and the view of the Fed is let's wait and see. A great deal of uncertainty. Let's have some of these clouds of uncertainty clear before they take the next move.